Kitco Mining's special coverage of the Precious Metals Summit in Zurich is brought to you by Wiesla Copper.
Is it fight or flight time for the US Federal Reserve? This is Paul Harris for Kitco Mining at the Precious Metals Summit in Zurich in Switzerland. Joining me to answer the question is Ronald-Peter Stoeferle, Managing Partner, Fund Manager of Incrementum and the publisher of the In Gold We Trust report. Ronald-Peter,
Hi,
welcome
Paul.
to Kitco.
Thanks.
Now, yesterday you said in your keynote speech here that the US Federal Reserve is approaching a point in time when it will either have to choose to continue to fight inflation or to try to preserve financial stability. What rests on the outcome of that decision?
Well, I think it's a big question, and I have to admit that that I wouldn't have expected, like 18 months ago, that the Federal Reserve will be able to hike interest rates that aggressively. I completely underestimated that. However, I think that we're coming closer to the end of this rate hike cycle. I don't really buy into this higher for longer narrative that is being kind of communicated nowadays. So I have to say that I think Jay Powell, he seemed a little bit confused in his statements, and so he confused markets with his view on markets. At some point he said, well, actually the financial markets have already done their part of the tightening. Yeah, I mean, just look at the bond market, what happened over the last couple of months. And then later on he said, well, actually, perhaps there's still some room for rate hikes. So I think what's really crucial now, Paul, is to not lose the credibility that the Federal Reserve has painstakingly rebuilt over the last couple of quarters. And I think this is really crucial to understand these days. If I look at the indicators that we follow, I have to say we're not moving into a soft landing, but rather into a hard landing. Why? First of all, the fiscal stimulus that was like the big driver for the US economy this year, it's fading out over the next couple of months. And the US economy was working on steroids, like, I don't know, having 8 espresso and 5 Red Bulls, it seems, yeah, fueled by this enormous amount of fiscal stimulus. Americans are running an 8% budget deficit, even though they're having full employment. Yeah. So the question is, where's the US deficit going to be if they enter a recession? So our indicators, obviously the yield curve, we've seen this steepening lately, which is the ultimate sign that we're moving into a recession. Then the leading economic indicator, which has a perfect track record, but also credit growth. Yeah? Credit is now even contracting. Yeah? If you have a look at M2 money supply, also contracting. So our indicators are clear. We're moving into a recession. That's not the end of the world, actually. But obviously, it doesn't really go hand in hand with the very, very restrictive Federal Reserve. So I think the Fed has hit the pause button. They will have to remain at current levels, but then at some point they will hit the panic button and start lowering rates again. And I think that this will really be the point in time when gold picks up momentum.
Do you think he really knows what to do? I mean, there's a big difference between perhaps what he should do or what the US Federal Reserve should do and what it would like to do. I think recent quarters have been characterized by Jerome Powell messaging ahead of the decisions what they may or may not do, and perhaps waiting to see what the market response to that is to then have the confidence to take a decision. Are we still in that kind of pattern?
I would say, and there's some people professionally just looking at everything the Federal Reserve puts out, and I would say that some of the commentators that I really enjoy studying, they said, well, it seems like the most confused Federal Reserve in ages, and it seems there's like I think there's kind of a divergence that we're seeing now coming out of those statements, and this uncertainty is something that the market doesn't really enjoy. I have to say we've been wrong with our recession call. We've been way too early, but that doesn't mean that it's wrong. So from my point of view, I mean, if we enter in enter a recessionary environment, especially in an election year. There's no doubt that the Federal Reserve will lower interest rates. But I think it's important. We shouldn't expect that they will go back to the old game, basically going to zero interest rates and then massive quantitative easing. I think that would be too easy, because then they would have completely lost the reputation that they've rebuilt over the last couple of quarters. However, I think that there's no way that we enter a recession, the Federal Reserve can remain that restrictive. And it's not, as I've said, it's not only the rate hikes, it's also quantitative tightening, which is often forgotten. It's 1 trillion that is basically being taken out of the system. It's like, you know, if there's like a ballroom of investors and you slowly but gradually take out the oxygen, yeah. Some start to feel it a little bit earlier, and the fitter ones, yeah, they recognize it a little bit later on. And we're already seeing, you know, in the real estate market, we're seeing it in private equity, we're seeing it in so many rate-sensitive sectors that actually things start to crumble pretty quickly. So, you know, Europe is already, large parts of Europe are already in a recession. China is not doing so well. So the US is kind of the last man standing, but only and primarily due to this massive amount of fiscal stimulus that we've seen.
One of the other things you spoke about yesterday, political, geopolitical factors, you mentioned we're obviously at a time when there's 2 wars on the borders of Europe at this moment, but you also focused on the increasing geopolitical struggle between East and West. And maybe that's one of the drivers behind Eastern nations, the central banks of Eastern nations, increasing their gold purchases, presumably swapping out treasuries for physical gold bullion. Is this the first wave of a bigger geopolitical de-dollarization?
I'm not sure if it's de-dollarization. I would say that before we see any de-dollarization, we will see a de-euroization. Yeah, and I tweeted out the chart regarding the market share of the euro and the dollar in the SWIFT system. And actually, for the dollar, it's still going up, and for the euro, it's collapsing. Yeah, so I think that the euro will be the next victim of this development. And I think that, you know, last year we saw an all-time high in central bank gold buying, 1,100 tons, up 180%. The first 3 quarters of this year, 800 tons of buying. And I think that actually we tend to criticize central banks quite often with their interest rate policy. But then when it comes to their physical gold buying, I think it actually saved the gold market in the last year, because I tweeted out a couple of charts showing, you know, this enormous divergence between the tips and the gold price. And I think it really started with the Ukraine war. So actually this was the time when many countries that are somewhat critical to the United States realized that actually with a stroke of a pen, currency reserves can be wiped out. And I think this was a big warning shot to many other countries, yeah, like China, obviously. They've been buying like crazy recently, but also Turkey. But then there's Poland, for example, wants to double its gold reserves up to 600 tons. Singapore was buying. So it's the usual suspects, but then also some other countries. And I think, you know, those central bank buying programs, they will remain for the next couple of years probably. Those are long-term programs, and I think this is a really essential physical driver for the gold market, because, and this is something that could also be some sort of a trigger for the next stage of this rally. Actually, Western financial investors have not participated in the rally so far. So we've seen six consecutive quarters of outflows in gold ETFs. And also there is a big divergence between the West and the East. So that the North American and European ETFs were sold, 200 tons, while Asian ETFs were buying. So I think this is quite telling. Central bank demand being really robust. There is no Western financial demand. But I think as soon as we hit new all-time highs in dollar terms, I think that this FOMO will kick in and that ETFs will become one of the triggers going forward.
In your latest monthly gold compass, published in November a few days ago, you said you highlighted how gold is proving resilient, noting once again it surged up to that $2,000 per ounce mark in October. Why is it proving so hard to get over that $2,000 per ounce?
It's a psychological thing. So probably many people think, yeah, 2000, we could never really take out the all-time high. That's a big psychological number where some, just want to sell. On the other hand, I think, we're always staring at the dollar price of gold, yeah, while in basically in every other currency, gold has made new all-time highs over the last couple of months. In Japanese yen terms, gold is up 25% year to date. In euro terms, gold is up, I think, 8.9%. So actually, I think gold is exactly what it's supposed to do. It's protecting you against loss of purchasing power. It's pretty stable. Volatility is fairly low recently, and I think that's the interesting thing. This divergence between the price action being really positive, really constructive, and then on the other hand, sentiment still pretty negative. Yeah, and it seems that people couldn't care less about gold, and I think that just shows me that we're far away from a mania stage so far. If you have a look at the forecast based on Bloomberg, all the analysts that are questioned, it seems that everybody's bearish on gold. Yeah, so that's a pretty good setup from my point of view. And I think there are no triple tops. Yeah, I think once we go over, then gold will really pick up momentum, and we can go to 2,300 pretty quickly.
You mentioned at the start of your speech yesterday that a year ago, gold was trading at $1,650 an ounce. So as you say, there's been quite a step up in the past year. And October, gold closed about $15 from closing the month or monthly close above at or above $2,000. And that's a very critical technical indicator, isn't it? Closing above 2,000. Yeah. If gold does, what does that mean?
Well, I think it's what you don't really see at the moment is CTAs, managed futures, and those kind of momentum-driven participants. I think they're still kind of on the sidelines, and I think signs like this, a monthly close above 2,000, would probably trigger some buy orders for like more technical oriented investors and programs. So that could be one thing, and then I think it's what's really important from the current or the short-term price action. We crunch the numbers regarding gold reacting to geopolitical events, and with the whole when the whole tragedy in Israel started, people got really excited about gold, yeah, and we always said, well, actually those rallies are rather short-lived, yeah. But then on the other hand, what does war mean? It usually means more inflation, more debt, and lower interest rates, yeah. So I think those developments, those very unfortunate geopolitical events that we're seeing, and it's not only Russia, Ukraine, and Israel, it's also some other minor geopolitical conflicts that seems to be popping up. Yeah, make a stronger case for gold. But I think what's really important, Paul, is that I really want to make a positive case for gold. Yeah, not wars all over, hyperinflation, buy gold. I think if you have a look at the gold flows from the west to the east, this is really staggering. And we had a whole chapter about the gold flows and the infrastructure of Asian markets and how it developed. So actually over the last 20 years, 30,000 tons of gold moved to China and to India. China and India used to be 28% of gold consumer demand. Now they are responsible for 50%. Indian housewives own more gold than the US owns with their 8,100 tons. In general, the Indians own more than the combined amount of the 27 largest central bank gold holders. And I think for us in the Western world, those numbers, somewhat underreported, yeah. And I think it's really important how much gold is really flowing into emerging markets, and it's actually not coming back, yeah. And I'm going to Dubai next week. I'm traveling quite a lot at the moment, and if you go to other cultures like Dubai, for example, their affinity for gold and the importance for gold for people there is just a completely different one. It's like the foundation of a portfolio. It's not like somewhere in the investment universe. It's a satellite investment, an alternative investment that you add to your balanced portfolio. It is actually the foundation of the portfolio. And I think with inflation proving to be pretty volatile, and I said in my keynote, we've seen the end of the great moderation. So basically 4 decades of falling inflation. I think inflation volatility will become a main trigger going forward. I think that gold will slowly but surely also in the Western world come back as a, just a, the foundation of the portfolios, because the higher inflation is, obviously the more gold you want to have in your portfolio. And I think this could be changing, but it's a long process.
Well, investing in gold and having that in your portfolio is, depending on who you speak to, a good building stone or a good safety net. But let's talk about another way people can get exposure to gold, and that's obviously the gold equities. Gold equity prices are pretty much in the doldrums at the moment. They can do with some a golden touch or golden sprinkles on their share prices. How long do you think this bleak market will last, and what will it take for the gold equities to see better days?
Well, actually, I think we have to differentiate between the producers, the developers, the royalty companies, the juniors. I think the producers are doing okay. I mean, they're producing decent free cash flows. They're paying out nice dividends. Their charts don't look terrific, yeah, but it's not a disaster. Yeah, royalty companies are doing quite okay. It's a perfect scenario for them, actually, in a cash-starved environment. Developers and juniors are having a hard time, and I have to say, I don't think it's gonna get better very soon. I don't think that risk appetite will come back very quickly, even if we're seeing the big pivot by the Federal Reserve and central banks in general. I think it will take time for risk appetite to come back. Usually, a spectacular share price performance does a good job of, attracting interest and attracting new investors. But many companies have just shown that they're very efficient destroyers of capital, and I think that people remember that, yeah, and that it's hard to regain trust, yeah, and to rebuild that trust in the industry. Then on the other hand, I mean, I quoted the old saying that actually you make most of your money in a bear market, you just don't realize it at that time. So given the progress that I've seen for some companies putting out tremendous drill results, yeah, and actually the stock, quickly turning up, and then it's being seen as a liquidity event, and then actually it sells down. I think some companies are real bargains at these levels. So if we take a step back and have like the long-term view, I think it's a great buy for those quality names. And as the market usually does, the low-quality names will be wiped out, or they will be renamed and become lithium or AI companies or whatever. Yeah.
Now, you're also a portfolio manager, so I don't expect you to name, and I don't want you to name names, but what kind of gold companies are you investing in? Whereabouts of all of those that you mentioned, where are you putting your money?
At the moment, we like the mid-tier producers. I think there's a really decent risk reward. We bought some royalty names quite recently. We're somewhat hesitant when it comes to developers and juniors. And I think you don't have to be too aggressive. You can really find decent risk reward with some smaller producers, those putting out like 100,000 to 300,000 ounces. There's really, really good value. Companies that really delivered, that are sold down mainly for liquidity reasons. And I know how this business works, yeah. If you're facing redemptions from your investors, you just have to sell positions, yeah. So you have got this cascading effect. So this is where we're allocating capital at the moment. I think it's not time yet to take too much risk.
Okay, we're coming to the end of 2023. What do you think will happen next year? And what would you like to happen next year?
I would love to see Austria winning the Euro Cup in Germany. That
I didn't ask for fantasy.
So that's my top priority. Yeah.
Okay.
No, but
I suppose there's a gold aspect to that.
no, I think that going forward, as I've said, we're still in the recession camp. Yeah, I just don't think that this cycle is different. That indicators like the yield curve with a perfect track record, the leading economic indicator, credit growth, and so on, that they're sending the wrong message. It just takes longer because of this fiscal stimulus. As I've said, what do we usually see when the bad R word happens? Yeah, we're seeing fiscal and monetary stimulus. Obviously, we're having an election year next year that should also help. And we crunched the numbers in our lasting gold with trust report and actually said every recession is kind of different and there are 4 different stages. So what works in each stage of a recession? And gold works pretty well as a recession hedge. And interestingly, bonds also work well. But then stocks, so the S&P 500, commodities, and silver have a hard time over recessions, only start performing at later stages of a recession. While mining stocks actually do really well over the course of recessions. Yeah. So that could be an idea, obviously. And I think, and that's completely off topic, as you know, we also combine in 2 of our funds actually traditional gold, yeah, with digital gold, with Bitcoin. And I'm pretty excited regarding Bitcoin for the next year. There's 2 main triggers, which is the halving and then the Bitcoin ETF. And I think this will go along with lots of capital flowing into the sector. I think the price action looks really interesting. So I think this is also something that really excites me. But going forward, I think, you know, those numbers when it comes to debt creation, it's hard to understand, it's hard to grasp. Yeah, you know, just since 2019, the US took on more than 10 trillion of new debt. So I think, you know, I showed a couple of charts where it's actually we seem to be at a tipping point where. You know, at these rates, yeah, it just the math just doesn't work out anymore. Yeah? So I think that if you believe in simple math, we simply corporations, but also governments and private individuals cannot afford interest rates at the current levels. Yeah, so they have to fall. The question is, will this, you know, re-inflate markets? Yeah, will it add to further inflation going forward? That's a big question, and this would kind of fit with my picture of more inflation volatility. So while we're seeing disinflationary pressure now, I think the inflationary pressure is already kind of building up under the surface.
Well, I think it's going to be a fascinating and interesting next year, good and bad. Ronald-Peter, thank you very much for joining us.
Thank you very much, Paul. Thanks.
This is Paul Harris for Kitco Mining at the Precious Metals Summit in Zurich, Switzerland. And if you like what you see, don't forget to subscribe.
Kitco Mining's special coverage of the Precious Metals Summit in Zurich is brought to you by Copper.